so let's talk pros and cons of whole life versus IUL. There is a video on that in my feed, and I think I go through a basic pros and cons list. But when I talk about IUL and whole life, sometimes in the flow of conversation I bring out things that I might have forgot to put in that video or things that I've thought of since then. So, basic overall concept behind whether I like to direct somebody to whole life or an IUL depends on what they're planning to do with those products. What need does it have to serve in your financial life or your insurance life? So, first off, most of the times people are coming into one of those two things. They're narrowing it down to one of those two things because they want a place to start putting their extra money. My first question ends up being, what is your current life insurance situation? Do you have enough life insurance for your financial situation as it sits right now? For some people, the answer is yes. For a lot of people, that answer is no. If that's the case, and not necessarily just term insurance, but whole life insurance or some type of permanent insurance, what do you currently have? Because term insurance is good. Term insurance, you can get the most life insurance that you can qualify for in a cheap way by using term insurance. But it is just a straight expense, and it's going to end at some point. So when that term insurance ends, whether it's 20 years or 30-year term, now you've got a decision to make because the cost of that insurance is going to skyrocket. And most people stop paying at that point because they're not prepared to start paying the cost of annual renewable term insurance. That's why whole life comes in handy. That's when we look at my wealth pyramid. If you check out that video, one of the things in the bottom of that wealth pyramid is insurance. Whether it's health insurance, home insurance, auto insurance, or life insurance. Insurance plays a part in building a solid financial base. It ensures that we are not going to get in trouble because of some crazy emergencies or some things that happen that we had no idea were going to happen. Your house burns down, that's a huge expense to have to take on to rebuild and have shelter if you don't have insurance that's going to cover it and help you rebuild that. Because most people are not setting aside enough money in order to rebuild their house. So the $1,000 a year that it costs us to have home insurance ends up being worth it, even if we never end up with a house fire. Having that as a backstop allows us, it frees us up to instead take that money and invest it or do something else productive with it. So that's what insurance serves. It helps to solidify that financial base so that you don't get into trouble and you can then focus your extra money elsewhere. Now, life insurance is a little bit unique in that there are products that can serve to cover our financial insurance needs, and we can also use them as tools for growth and use them as ways to invest in other things. So this is the whole idea behind the concept of infinite banking. So first things first, how's your insurance? That's what we would look for. We want to make sure that when you get to old age, hopefully you get to old age, you're going to be covered. You're going to have a base amount that your loved ones, you're going to be able to leave them a legacy gift. Your beneficiaries are going to see the fruits of your labor throughout your life. They're going to be able to benefit from that. Most people would rather see their family benefit from that when they move on rather than leaving them struggling and figuring out what are they going to do now that this person has passed away. Insurance is a great way to make sure that that need is covered. My family has never had insurance as far as I'm aware of. They just hadn't had the money to use for that. Nobody talked to them about these uses of it in ways that we can use it as an asset. It's always been an expense, and it was an expense that was just not at the top of the priority list, or it never made it high enough up the priority list to actually do anything about it. So for that reason, we haven't had anything passed down to us. So we're basically starting fresh with each generation. That changes with my generation. I'm I have a legacy gift in place now. Me and my wife both have a legacy gift in place that we know we're going to pass on to our kids. And we did that through use of whole life insurance and index universal life insurance. Two permanent products that eliminate my need for any type of term insurance. And they provide growth, guaranteed growth as far as the whole life product goes, and potential growth as far as the IUL goes. First things first, we have to figure out where we have enough insurance, right? If we don't have permanent insurance underlying this, if we just have term insurance, then I look to setting up a whole life policy, because whole life, you have a set cost for your insurance. We know what it's going to be when we set up your policy for the rest of your life. An IUL, you have annual renewable term underlying that policy. It starts off very cheap and then it gets expensive. So if for some reason you'd start an IUL policy, you're putting money into it, and the stock market just stops growing, okay? Now the growth in this policy is reliant on growth in the stock market. That is how that policy grows. And we are anticipating that low cost of insurance, when we first started out, we're going to have that low cost of insurance until we get to like 65 or 70 years old. So we have, however old you are, up until 65 or 70 to take advantage of that low cost of insurance and the growth in the stock market. And our hope is, the plan is, with the consistency and the growth of the stock market, we're going to see your account value grow at a much, much faster rate than the insurance costs will go up. Because really the insurance costs go up only a little tiny bit each year, okay? They don't start jumping up until we get to that older age, which is why I say it basically skyrockets when you start to get older, usually past like age 75 or so. So, on the off chance that the stock market does not perform, you're better off having been in a whole life product that has that guaranteed cost of insurance that you know will be there in old age when you eventually pass away. The IUL, you may need to cancel it at some point because it just doesn't perform if the stock market doesn't perform. Now, I believe that it will perform, which is why I own those policies, and it's also why I don't put my money in the stock market first, because when I look at the stock market and I compare the IULs to the stock market, I much prefer the safety of an IUL. When you compare those two, it's no contest. If I don't have any losses that I have to eat in the IUL, and I do have potential losses in the stock market, I'm going with the IUL. When you compare the IUL to the whole life, now it changes. And now the IUL is the one with a lot of risk compared to the whole life. The whole life does not come with the risks. You get a lot of guarantees. You get guaranteed growth. You have guaranteed loan provisions, which you also have in the IUL. But you also get dividends, which you do not get with the IUL. And with the companies that we use, they've been paying dividends out for 150 plus years. So the odds are they're going to continue paying out for the next 150 plus years. And we are counting on that for the growth in our policies. So first things first, we take care of a whole life insurance and make sure that when we pass away, we're going to have enough insurance to pass on to our loved ones. Now, if you're just now coming to me and you've already made millions, you got money in the bank, your loved ones are going to be fine, you may skip that portion because you'll be considered self-insured, right? What a lot of the financial gurus like to say, the reason you should just do term and buy term and invest the difference is because by the time you hit retirement age, you won't need that term insurance when it goes away. You'll be able to self-insure. Well, most people that does not work. So that's why we like the IULs and we like the whole life, because they inevitably either don't pay the term insurance, they don't invest the difference, or they encounter an emergency that ends up eating up everything that they have been investing the difference in, and they end up not having enough money to be able to self-insure. And self-insuring can be pretty expensive anyways, especially when we have a good alternative like our infinite banking through these whole life policies. That's the the best way to do it, in my opinion, because you have those guaranteed growths and you have access to that money. So you can still pull that money out and invest it if you want to. You're just doing it first. You're securing that death benefit first, the permanent death benefit that will pay out no matter what, and then you're going to do the rest of it. So whole life insurance first, then the IUL. That's the direction I go. Pros and cons, I really like them both. It just depends on what you're going to use it for. So an IUL, I love it as a retirement vehicle. It's a great replacement for the Roth IRA, or for people who make too much money and they can't participate in a Roth IRA, and for some reason they're unable to do backdoor contributions through their employer. There's obviously different ways that you can get around not qualifying for being able to open an IRA directly or a Roth IRA directly. The IUL, you don't even have to worry about that. You don't have to worry about backdoor Roths. You don't have to worry about contribution limits. You can set up your policy and you can contribute whatever the MEC limit is in those policies, which is substantially higher than any of the limits to the retirement vehicles that you have the opportunity to use. So big benefit there from the IULs. The other benefit, you get the growth in the stock market. So growth in the stock market, we love that. The consistency that we've seen in the stock market, it does go up. The only downside is sometimes it goes down. And it's when it goes down that you can really get in trouble if you're in a position that you have to withdraw your money. If you don't have the time to let the market go back up again, you're going to be in trouble. Happened to my grandma. They took all of their retirement money that they thought they had plenty of money to live throughout their retirement, and they put it into, on the advice of a financial person, they put it into a variable universal life product, which basically just turns it into being at risk of the stock market. Even there's really no reason that they should have been in that product. I'm not a fan of those. But what happened was, they're in retirement, the recession hit, 2008. Wiped it out. Wiped out their retirement, and not only was it down, but they were pulling out money every year to live on it, and they could not stop doing that because of the bills that they had. And they had that design assuming that they had some type of safety in that they would be able to pull it out for the rest of their life. That didn't work out, and it ended up really hurting them. They basically got wiped out. They had to downsize. They had to sell the house they were in, move into a much smaller house. I won't get much more into it. It wasn't a good situation. Let's just leave it at that. So anyways, point being, I don't like the risks of the stock market. I don't mind having some or even a substantial amount of investment in the stock market. As long as you have some that's invested in, I shouldn't say invested, as long as you have some stored, because we view these as savings type assets, as long as you have some stored in life insurance that's serving a need to provide safety for you. So a lot of times we'll look at and we'll consider IULs as a safe place to store some of that money, some of your investments, and when the stock market's down, you can pull money out of there instead of pulling it out of the stock market. And then you can have the opportunity to give your money that's in the stock market time to go back up. People have done examples of that and shown how it's greatly increased not only how much they can pull out each year from the traditional 4% rule, but it's provided a much more stable base throughout retirement to ensure that that 4% rule will even stick around. Regarding your grandparents, did they do a withdrawal versus loan from their policies? That I don't know. Since they were doing a VUL, I would assume that they were doing withdrawals. I can't imagine a scenario where they would want to be doing loans on that type of a policy. But I haven't sold those before, so I don't know how they sell those, and I didn't get into it with them about how they were pulling the money out. Which one is better, in my opinion, of the IUL versus whole life? I like them both. I wouldn't say one is better than the other, except for if you have a specific situation. So if you have a particular situation, then I can say this one's going to be better than that one for this particular reason. I really like National Life's IUL because of their 4 living benefit riders. Their 4 living benefit riders are cream of the crop when it comes to all of these life insurance policies, and having access to the full death benefit, or at least a large portion of the death benefit above and beyond the cash value in the event of critical illness, critical injury, chronic illness, and terminal illness. That's what those provide. So I like to have a National Life product on me, at least for a small amount. Now, because it's an IUL, and there's the risk in, well, a couple of reasons here. Because it's an IUL and we have risk in the growth, and because of National Life's policy of not having access to loans in the first year, that really limits the amount that I would commit to it in the first year. So for me, I put a small policy in National Life, meaning about $6,000 a year. I put that into National Life, and that gives me a death benefit that I know will be accessible in the event of one of those riders needing to pay out, and I get the opportunity for growth that goes along with being in the IUL. And their cost of insurance is actually really low too. So there's really good performance that I get from that product when we illustrate it and we compare it to other products. Now, I put a large portion of my income into whole life products because of the flexibility. And really, I put a large portion into Guardian because of the flexibility that Guardian offers. I don't have it set to the index option because I plan to put a lot of money in and take it out constantly, and they really don't want you doing that if you have it assigned to the index option. The way I view the index option of Guardian is use that option if you want to use the cash value in that policy as actual growth, if you want to use that for your investing needs within the policy. If you're going to do your investing outside the policy, so if you're going to be buying real estate or investing in other cash flowing assets outside your policy, don't even worry about the index option. The difference between that, the potential in that, and the dividends is not that much. You're much better off just worrying about what you're going to invest in outside of your policy. That's where you're going to get the growth for that money. Okay? I'm going to finish up that first question. How would I structure either or both for the whole life and the IUL? So we're back to the whole life versus IUL, and this may carry us to the end of this session. But so how to structure them. When it comes to IULs, the structure designed for an optimal design for an IUL uses what we call the face amount, which is essentially the same as the base premium in whole life. And then we try and blend with that as much term insurance, or we call it cheap term, as we can. Now, what makes that cheap 1-year term insurance less expensive than the face amount that's also built on 1-year term insurance? Well, the difference is the insurance company pays me a commission on that base face amount, and they will only let that be a certain percentage of the overall death benefit. And the additional term insurance, they say, okay, we'll let you design it that way, but the reason there's going to be an advantage, the reason it's cheaper, is because you don't get paid commission on that portion of it. So, great, that's fine. Let me design it the best for my clients. What it ends up looking like is you get this very small face amount that I get paid commission on, and you have the ability to contribute based on this whole entire death benefit amount. So it turns into a lot more cash value for you. If we do enough of these policies, I get paid just fine. I don't need to make the big commissions. I was telling somebody earlier today, somebody shared, it was somebody from last week's live stream. Somebody shared an IUL video. It was an Allianz video that a guy was showing how to optimally design a policy. And his initial one that he was comparing a bad design to was using a option A death benefit, which is a level death benefit. They were putting in $50,000 a year, and if you look at anytime you're looking at an IUL illustration, look at what the target premium is. The target premium is what the agent's commission is based off of. So with this other video that this person was doing in comparison to, he showed a $50,000 premium design that had a target premium of $48,000. So if I sold that policy, I would get about $48,000 to $50,000 on that policy in the first year, just for the first year. Okay, that's the first year is where we get all of our commissions. We get a small recurring amount, 3% or less, in subsequent years after that. Okay, so that first year, that agent would have been set up to get a $50,000 commission, and the cash value for the client, zero, nothing. So whatever we get as a commission comes directly off of what you could see for a potential. Okay. Now we got to get paid something because we don't do this for free. Everybody has to work. Everybody needs to have an income. But how high does it have to be? Doesn't have to be 50 grand. I'll tell you that. Okay. So this other agent, he says the optimal design, you switch it to an option B. You switch it to an increasing death benefit. And he left it there. He showed this design, which obviously looks way better. Cash value growth in the policy is pretty good. I mean, it's actually really good because the underlying product that Allianz offers is great for illustrating potential growth. So that's what he did. He just switched it to an increasing death benefit, and now the target premium was $19,000, which means he's going to get paid $19,000 to $20,000 for writing that policy. He felt pretty good about that design. He tried to say in the video that was an optimally designed policy. You know, come do business with me because I'll do these better for you. Well, on a $50,000 annual premium, $19,000 or $20,000 commission is still way too high. Okay? When I design those policies, and I'm going to do an Allianz one here soon where I can show you, and basically people can compare it to that one that was put out. But I'll do this. I'll do the same numbers that guy did. $50,000 annual premium, you should be able to get that target premium down to $5,000 or $6,000. Ideally, if you're looking at an illustration and you want to know if it's a good design, you'll want to see that target premium be close to about 1/10 of what you're planning on paying in premiums. Okay. This was a question asked and answered during one of our Wealth Care Wednesdays live streams. If you have any questions, leave them in the comments section below, or join us on one of our Wealth Care Wednesday live streams where you can ask the question and we'll answer it on the air live. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.